Since 1978, Triland Properties has been at the forefront of creating value in grocery-anchored shopping centers. In this video, we'll delve into how Triland unlocks values and creates exceptional returns for its investors. First and foremost, let's understand the concept of a capitalization rate, or better known as a cap rate. In short, the cap rate is the ratio of the net operating income to the property's value. Its formula is simple. Cap rate equals net operating income divided by the purchase price or property value. This is a key metric in commercial real estate, representing the expected rate of return for that particular real estate investment. The cap rate has an inverse relationship with the property's value. A lower cap rate implies a higher property value and vice versa. Think of it like a seesaw. Low cap rate, higher purchase price or more expensive, and a higher cap rate produces a lower purchase price or a less expensive property. To illustrate, consider two properties with an equal net operating income of $1.2 million, but different cap rates, say 8% and 6%. Using the cap rate formula, property 1 is valued at $15 million, while property 2 is valued at $20 million. Now that we have a better understanding of the cap rate formula, there are two simple ways to create value mathematically. First, by improving or lowering the cap rate, and second, by enhancing or increasing the net operating income. Let's look at this in more detail. We're going to use the Hub Shopping Center, a 160,000 square foot grocery-anchored shopping center previously acquired by Triland in 2022, for our example. We're going to assume that we bought the shopping center with a $1 million net operating income for a cap rate of 10%. This is equivalent to a $10 million purchase price. Sometimes in real estate, you can create cap rate arbitrage, basically exchanging higher cap rates for lower cap rates. When you buy the entire shopping center for a single cap rate, the higher rate, and sell the smaller outparcels, sometimes known as single-tenant net lease transactions, for a lower cap rate. Imagine we sell the Burger King outlot. Originally purchased with a 10 cap rate, but as a single-tenant net lease, we can assume we can sell it at a 6 cap rate. The resulting net value, excluding costs, creates a $566,000 in net profits for its investors. This is a simple example of how cap rate arbitrage can unlock value in real estate. Now let's take a look at increasing the net operating income for this property. Triland's business plan is to reduce the grocery store space from 100,000 square feet to 70,000 square feet, in which we will knock down approximately 13,000 square feet and lease a junior anchor space of 17,500 square feet. Upon purchase, the grocery store will pay $4.50 a square foot for the 100,000 square foot space. Once reduced to 70,000 square feet and remodeled, the new rent will be $8.50 or $595,000 a year. This will increase the rent by $145,000. In addition, Triland will rent the junior anchor space for $12 a square foot for a total of $210,000 a year. The incremental increase over the original rent will be $355,000, and using a 10% cap rate would mean we increase the value of the property by $3.55 million. This showcases how altering the usage of space can significantly impact investor returns. In addition to cap rate arbitrage and rent increases, Triland utilizes economic incentive packages like TIF, CID, and TADS to increase investor returns. If you want to know more about how TIFs work, please visit our YouTube page. Let's assume an investor had invested $5 million in equity into the project, and the cost of renovations are approximately $10 million. After completion of the development and increasing the net operating income to $1.5 million, we'll assume we can sell the property for a 7.5% cap rate, or $20 million. This results in a $5 million net profit for the investors over the 5-year holding period. Now, introducing a $4 million TIF would reduce the development cost to $6 million and increase the profit to $9 million. This TIF strategy increases the internal rate of return to 22.84% over the same 5-year period. This further demonstrates how economic incentives can significantly benefit investors and projects alike. These are simple examples to help illustrate how Triland Properties unlocks value in grocery-anchored real estate for its investors. If you want a more in-depth understanding or information on specific projects, please don't hesitate to reach out. And always, thank you for watching.